studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
The excluded business test is often considered the most important exception within the entire TOSI framework. In many cases, it is the first exception that tax practitioners examine because it can provide a straightforward path to removing dividends from the TOSI rules. At its core, this exception focuses on one question: was the individual actively involved in the business? The legislation is designed to distinguish between two very different types of shareholders. On one side, there are passive shareholders who simply own shares but have little or no meaningful involvement in the operations of the business. On the other side, there are active participants who regularly contribute their time, effort, skills, and expertise to help the business succeed. The excluded business test is intended to reward genuine participation. If an individual has been actively engaged in the business on a regular, continuous, and substantial basis, dividends received by that person may qualify for the excluded business exception. When that happens, TOSI may not apply. Notice that the focus is not simply on ownership. Owning shares alone is generally not enough. The key factor is involvement in the business itself. Active involvement can take many forms. The individual may be managing employees, meeting with customers, handling administration, overseeing operations, performing technical work, participating in business development, or carrying out other important responsibilities that contribute to the success of the company. This exception recognizes that family members who genuinely work in the business are different from passive investors who receive income without making a meaningful contribution. As a result, the tax rules provide relief when real participation can be demonstrated. The excluded business test is especially important because it is often one of the strongest and most practical exceptions available. When the facts support active involvement, the analysis can become much simpler than some of the more technical TOSI exceptions. The key takeaway from this slide is that the excluded business test rewards genuine participation in the business. Real work, performed on a regular and ongoing basis, may allow dividends to qualify for normal dividend taxation rather than being subject to the TOSI rules. One of the most common questions practitioners ask when applying the excluded business test is, what does it actually mean to be actively engaged in a business? The legislation uses the concept of regular, continuous, and substantial involvement. While every situation depends on its specific facts, the CRA has provided a very helpful guideline that is often referred to as the 20 hours per week safe harbor. Under this guideline, if an individual works at least 20 hours per week in the business during the relevant part of the year, they are generally considered to be actively engaged in the business. This can significantly strengthen the argument that the excluded business test has been satisfied. It is important to understand that the focus is not simply on showing up occasionally. The involvement should be consistent and meaningful. The individual should be contributing real value to the operations of the business on an ongoing basis. Active work can take many forms. It may involve managing day-to-day operations, supervising employees, handling administration and bookkeeping, meeting with clients, generating sales, providing customer service, performing technical work, or participating in management decisions. The specific activities are less important than the overall level of involvement and contribution. The slide also highlights examples that may not be enough on their own. Providing occasional advice, attending only a few meetings during the year, holding shares without participating in operations, or performing only minimal and inconsistent work may make it more difficult to establish active engagement. The 20-hour guideline is helpful because it gives practitioners a practical benchmark. However, it is not the only way to qualify. The actual legislation focuses on the facts and circumstances of each situation. There may be cases where an individual works fewer than 20 hours, but still demonstrates substantial involvement based on the nature of their responsibilities. Likewise, simply recording 20 hours is not automatically sufficient if the work performed lacks meaningful substance. The quality and significance of the involvement remain important considerations. The key takeaway from this slide is that active engagement means regular, continuous, and substantial participation in the business. The 20-hour-per-week guideline provides a useful safe harbor, but the ultimate determination always depends on the overall facts and circumstances of the case. Understanding the excluded business test is only half of the challenge. The other half is being able to prove that the test has actually been satisfied. In tax matters, facts are important, but evidence is equally important. A taxpayer may genuinely be involved in the business, but if that involvement cannot be demonstrated through records and documentation, defending the position becomes much more difficult. This is why practitioners often ask a simple question: can you prove active involvement? One of the strongest forms of evidence is timesheets or time records that show the hours worked and the nature of the work performed. These records can help demonstrate that the individual was regularly engaged in the business throughout the year. Work schedules and calendars can also be valuable. They provide evidence of ongoing participation and can support the claim that the involvement was continuous rather than occasional. Emails and other business communications are another useful source of documentation. They can show involvement in management decisions, customer interactions, operational matters, and day-to-day business activities. Meeting minutes can help establish participation in strategic discussions, business planning, and important corporate decisions. Similarly, project records and work product can demonstrate the specific tasks and responsibilities handled by the individual. In some situations, employee testimony or statements from other individuals involved in the business may provide additional support for the taxpayer's position. When strong documentation exists, the excluded business exception becomes much easier to support. A well-documented file creates a clear link between the individual and the business activities being performed. This can significantly strengthen the taxpayer's position if the matter is ever reviewed by the CRA. On the other hand, weak documentation creates risk. If there are few records showing what work was performed, when it was performed, or how regularly the individual participated, it may become more difficult to defend the exception. This can increase the likelihood of questions from the CRA and potentially lead to a challenge of the taxpayer's position. The key takeaway from this slide is that active involvement should never exist only in memory. It should exist in the file. The strongest defense for the excluded business test is evidence of real, ongoing, and well-documented participation in the business.